This panel is one of my personal favorites because as we started talking earlier today, it is necessary but not sufficient to be really good with the quant stuff. You really need to be able to communicate it, and this panel has just really good thoughts on how to make that a successful element of what you're doing. I think they'll probably also share a few tales with you of experiences. As we did say before, it's always good to make a new mistake and not one that we all made. Although Maggie and I were discussing that if we were just going to go through our mistakes, we'd probably need a 2-day panel just for ourselves. but you know,
that's just for me.
Okay, 4 days. I need my 2 days too. But at some point we should publish those. That's right. But in any case, I'm going to turn it over to Maggie as the chair of this panel and do a little, they'll tell you a little bit about who they are and their backgrounds and then launch into the topic. So,
okay, great. So, my name is Mila Getmansky Sherman. I'm associate professor at University of Massachusetts in Amherst. I'm a professor in business school, so lots of questions that were discussed today is, there are some people from business school, some people from math departments, some people from operations research. I had a privilege being at MIT, where I work with different parts of it, so work with engineers, work with managers, then work with finance professionals. So my undergraduate was also at MIT, and I did undergraduate in chemical engineering, and then I moved to Sloan School in management, where I did both system dynamics and finance, and then I transitioned to the Laboratory for Financial Engineering, also at MIT, where I did my postdoc. So going from engineering to kind of operation research to system dynamics and finance, by definition, I absorbed different strands of literature, practice, academia, which actually really helped me in my career. So now, as an academic, I work on issues related to investment, systemic risk, and understanding systemic risk is not just one little part of a system. I'm concentrating on looking at different financial institutions, looking at sovereigns, and so on. So my background, which kind of came from intersection of different fields, helped me to be successful in what I'm currently doing. And since this is a panel about communication, also communicating. As an engineer, I communicated one way, but then I had to go across the campus to the business school and learn how to communicate to people there, and then bring back ideas to my engineering colleagues. And that, since I was forced to do it, but it really was, at first it was kind of unpleasant or hard, but then it became very natural for me to communicate and kind of swim in different ponds, right? Also, because of that, I realized academia is not the only tower you have to get. You have to be in and get your experiences. So I work in industry at Deutsche Bank before, and recently I have been working with Securities and Exchange Commission, Federal Reserve Board, CFTC, Treasury, so with many regulators in Washington, D.C. to work on financial stability and regulation issues, which again span different spectrums. It's not just one part. But today this is just my ideas about communication coming from me, not from organizations I have represented.
Hi, my name is Cristina Polizu. My background is a PhD in mathematics from New York University. My specialty there was first passage percolation, which is related to statistical mechanics. I got interested in financial mathematics during my senior year there, and I'm working with Standard & Poor now for almost 20 years. I've been a quantitative analyst, transitioning through many roles. Currently, I'm heading a group of quantitative analysts, and we do research and modeling for structured finance. And for you who are perhaps not familiar with what structured finance is, because we are talking about communications and how we translate concepts for people who may not be familiar with the concept, essentially in structured finance, we analyze a securitization instrument where the cash flows are backed by the cash flow of a portfolio of assets. So structured finance research and quantitative analysis has a lot to do with portfolio credit risk. And that portfolio may be of corporate assets, of mortgages, residential mortgages, commercial real estate loans, credit card loans, student loans. So this type of consumer loans. There we study the credit risk of the portfolio, prepayment, interest rate risk, and we analyze the impact of these risk factors on the debt instrument that is the ultimate product and for which we analyze the risk. We quantify the risk.
Perfect.
Yeah. Great. Hi, I'm Maggie Stumpp. I'm formerly the Chief Investment Officer of an outfit that you've never heard of, but it's actually a very big firm. It's called Quantitative Management Associates. We call it QMA. It's a firm that I founded back, I don't know, 20 years or so ago. We went from practically nothing to now it's about $125 billion, which is the GDP of a good-sized country. It's all quant, and we do everything from sort of low-risk index funds, marching out the scale to enhanced index, marching out the scale to traditional active equity, and continuing all the way up to levered and pretty aggressive strategies. So it's a whole family of things we do. We have, I don't know, about 15 PhDs at this stage. The PhDs range from physics, mathematics, economics, finance, even history. I don't know how we get the historian, but it's actually good to have a historian because you don't make mistakes that others have made. We make other mistakes. But it's a good-sized shop. It's a large amount of quantitative strategies. Our flagship strategy is a plain vanilla kind of quant. It's almost embarrassing to describe it at this stage. But it's been around for about 15 years, and I think we've beaten the market 13 out of the 15 years. So we've done pretty well by ourselves. We've got clients around the world. So you name a country, we probably have a client there. So that's what we do. Now I'm kind of getting old and have to color my hair and all of that. So I'm kind of chief investment officer emeritus at this stage, and I get to do whatever I want. And I guess the title is senior advisor. If it's okay, I'm just going to tell a story. But okay. So let me tell you a little bit about my career path, and it's going to lead into a story. I have PhD in economics from Brown. And I did my work on regulation and left Brown and decided to go into industry instead of into academe because I didn't like being poor. And did some work as a consultant and eventually came to the folks at AT&T sort of came upon me and they liked what I was doing, so they hired me to work with a bunch of other economists at Bell Labs, and at the time Bell Labs was the national think tank. I mean, they did phenomenal work. They had most brilliant minds that I've ever met. And we worked on breaking up the phone company, not because we wanted to, but because the government said we couldn't have one phone company, we needed to have a lot of them. So the reason you have Verizon and Sprint and all of these other companies now is because the government made us break it up. And there's a real question about how do you break up a huge national company, and that's why they brought in folks like me. After that, I started doing work with the surviving AT&T on rate of return regulation, and I became their witness and went around the country trying to convince regulators to allow us to charge too much for what we did. And so there was a lot of dueling academic work that I did, and that led to some other people looking at me and decided that I'd make a good person in finance. And my first job in finance was working for Prudential, and they had a group of people doing asset allocation. And I was brought in, and they said, well, this is before you really had computers. This is the sort of late 1980s. You had mainframes, but no personal computers. And I was brought in to work on asset allocation and to try to take a look at the market valuation at the time. And this is the summer of 1987. And I built a multinomial logit analysis kind of model that looked at the probability the stock market would outperform the bond market, and came to the conclusion that the probability that the stock market was going to outperform the bond market in late summer of 1987 was about 0. And went to my boss and said, it's about 0. And boss went to his boss and said, it's about 0. And his boss didn't like that answer. He was convinced that it was going to be the market was going to the moon. We had just discovered cold fusion. The internet was just coming online. Everything was wonderful in the economy. And because they didn't like that answer, they said, go back to the drawing board. I went back to the drawing board, came up with the same answer over and over again. And so what happened was that the group that I was supporting ended up going into the crash of 1987 overweighting stocks, and a lot of people lost a lot of money. And there's a few lessons from that story. Lesson number 1 is to kind of know your audience. What I didn't know at the time was that just making my boss happy wasn't enough. I had to give my boss enough ammunition to go to his boss to convince his boss. So it was not only making a good model, but it was also knowing where the results were going to go and giving people the information and the tools to help the second layer of people make information. So there was this know your audience thing that was really important for quants, and I didn't know it at the time. The other thing was having a good theory, and what I had done was pretty much just numeric analysis. I just threw a bunch of data into the computer and kind of came up with a cockamamie story, and it was hard to explain what multinomial logit is to somebody who doesn't understand that sort of stuff. So I'd go and try to talk about my model to these guys that wore suspenders and smoked cigars and thought they were the wizards of Wall Street, but couldn't take a derivative. And they just would look at me like I was from Mars. And so because I didn't have that kind of good story to hang my analysis on, I couldn't sell it. So that's the other part of this, I think, is having the tools, having a way, a theory that you can explain in very simple terms is really important to getting your ideas across. And when you can do that, all of a sudden people look at you and say, well, you're smart, and your career goes off. And the last thing was that I would go in with equations and show people equations. Here's a regression, here's all the statistics, and people it just goes right over their heads. And nowadays what I do is I go in with pictures, and here's a graph, here's a simple table, and I'm sure we'll get into more about this, but the way that you characterize what it is you do is really, really important. And it's not just here's an equation and it's significant and let's move on. It's about sort of the presentation. How do you wrap it up? How do you convince people that it's relevant? So 3 things: know your audience, have a theory, and the third thing is sort of be able to describe it in very simple terms using graphics or whatever.
Thank you.
Long story.
Cristina, can maybe you tell your story kind of about your experience with emphasis on communication?
Yes, with emphasis on communication. So in building a model, what I found out is very important. First of all, a project is a team project, is not one person's project. So definitely when we start a project, we have quantitative analysts, we have practitioners, people with a business background, we involve the economists, and it is important. I view a model as 3 main building blocks: is the data analysis, the model itself, the analytics, and then the interpretation of the results. And I think it's very important to spend time on the data and try to understand it, and bring other people to the working team, people who perhaps have lived those days, 1987, or now people who have lived 2008, the Lehman event, as we used to call it now. So spending time and understanding where you are in the cycle, understanding that if you're in a low-risk environment, it can change. If you are in a high-risk environment, it can persist. It's time well spent before starting to build the model, and it's good to have feedback from the other members of the team. It's good to understand whether you have cycles in the data, whether the data is long enough. What do you do if the data is not long enough? You have to go to proxies. You have to backfill. Here, the experience of other people with a good knowledge and understanding of capital markets can be very helpful on how to help you backfill the data. And then, of course, you need to understand if the backfill data deviates from, what are the implications of the backfill data with respect to the output. So I found that this part of building a model, one of the key steps, and discussing with the team whether the data has outliers. Do we have clusters around the outliers? Using the long-term volatility versus a short-term volatility, doing the rolling analysis, drawing picture. This is a picture of the rolling 3 months volatility. This is the picture of the graph of the 3 months rolling correlation. You can identify the periods where you had stress, and you can make decisions, collective decisions with the team. Do we go on the route of a regime switching model, or do we go with a simple model, one size fits all? These are important decisions, and it's important to discuss them before plunging into the math of the model and doing the calibration per se, because you don't lose the audience. And then the whole team is with you, and it will be much easier than when the third phase of the project comes with the interpretation of the results. We all sit at a table, we look at the output, we understand, yes, it makes sense, yes, this doesn't make sense, but that's the reason why. So I think engaging in a team from the very beginning engaging the team from the very beginning is important. Don't wait till the model is done to discuss the outputs, because sometimes the outputs cannot be explained without a good knowledge and economic understanding of the data. That's
great.
One message.
Thanks. Yeah. So a little bit also just about my experience and with emphasis on communication. So definitely working as a team, it's important, and it's something I feel it can be learned. Like when I was an undergraduate at MIT, I was known as the geek at MIT. So it's even within MIT, I was kind of a tail outlier. So I like to do everything by myself. You know, just give me a math problem, I will lock myself up in a computer room on Friday night. Was very happy. But now I totally don't do that, right? And it's kind of, but it's the same person.
I'm so glad.
Yeah, I get out. And so what I want to say, if you kind of look at ladies here and feel, well, it's not my personality, I don't think I'm that type of person. It's not true. You can be the shyest and just very quantitative, and maybe, when I was undergraduate, I just didn't want, I felt words will be a waste of time. Might as well use elegant mathematical equations to convey your point. You don't need to talk about it because it's a waste of time. So now you actually realize it's not waste of time, and nobody would care about your mathematical equation if you actually don't speak English and the right English, right? To different audiences. We'll talk about audiences in a second, but just from my experience, it's a learned behavior, right? It's the same way it's hard to learn stochastic analysis, stochastic processes, optimization, different mathematical equations. It's the same way you have to learn communication. Some people are born with a gift of gab. Some people are not, and it's a learned, right? And for me, it was definitely a learned part. So it's some kind of principles for me that stand out are good training. So you need to have a good training, and I think the panel before did emphasize that, especially in the beginning. Having a mentor. So at any point of life, having the right mentor. So if you're in the school now, make sure you look out for a mentor, right? Maybe it will be a professor or somebody in the academia. And I have had a really good mentor. Andrew Law, for example, has been a wonderful mentor, and even now. And having and a mentor will help also with questions such as, it was mentioned before, let's have summer experiences. Yeah, but there are many summer experiences, right? So if you have 5 different ideas of summer internships, the mentor can say, well, maybe for you, based on your background, maybe it's better for you to go into this environment, right? So actually starting with the right moral, there's no right or wrong, but starting with something that might click, it's actually helpful, and a mentor might know you. Also expand your network, right? Not just meet other mathematicians or other statisticians or econometricians, but people in different backgrounds. And I started doing this, and it really helped me, and it's actually, I like it even more. So now anytime I do lots of research, I try to bring a team, right? For example, I'm working on international CDS market using Merton model. So we have people from IMF, people from Europe, on the paper. Merton is on the paper too, so there's so you bring lots of people. I'm working on a cybersecurity risk. And again, I have people from operations research. I'm the only finance person there. So it's good to bring somebody not just the same as you, but actually know kind of, as people on the panel, ladies on the panel mentioned here, build a team, work together, and also understand your strengths and weaknesses, and build a team, not just the same people, but actually somebody who can complement you to lead to the to the right goal. In terms of model listening, that's really be humble and listen. It's really important. I learned it early on when I was undergraduate at MIT. The dean, right when we got to MIT, he said, well, you know what, 80% of you are valedictorians, but half of you will be below the average, just statistically, right? So you have to live with that. So you kind of that made me realize that, that's just the way it is. So you have to learn how to be humble, understand that there are other people who are smarter than you in different aspects, not just mathematics, again, communication, conveying information. So it's necessary to have good training to be a good quant, but it's not sufficient, right, to be successful. So you can be a good quant, but you actually, in order to be successful, you need to have you need to think about communication as an important asset you need to work on. Right? That's not something, okay, yeah, I will, the afterthought. You presented, you prepared, spend 100% of your time on the presentation, and then afterthought, you thought about communication. Think about communication. Even when I work, Bob Merton is my co-author actually in the paper, we spend most of the time actually how to convey information. So he said, Mila, the graph. I don't understand what you show. What is the y-axis? It's not labeled. I'm like, yeah, well, it's clear. No, label it correctly. The colors are important. So we spent half an hour on a graph. Why? Because communication is important. And so in the beginning, I was like, okay, whatever, she's like, why did you choose these colors? I don't think I even spent any time thinking why I chose those colors. It was automatic output. But actually think about why you choose colors, how to convey information. That's important. So moving on to we talked about communication. So communication depends on your audience, right? You communicate differently with your boss, with your colleagues, with your friends, with your family, right? So in this case, we'll probably talk about 3 levels of communication. One is among quants, another is among senior managers, so present your ideas to senior management, and another is to clients. And those 3 buckets are very different, right? But you can communicate the same idea to them. So for example, even the language can be different. You know, to your quants, to your friends, or to colleagues, you can talk about 2 sigma events, something happened, 2 sigma events, right? To senior management, you might say about low probability events. To clients, you can talk about black swan, you know. So the same idea, is just the language is different, right? So maybe if we can go on, you know, kind of each of us can talk about, provide specific examples of successful communication. Let's start with quants. And I know you mentioned already some, so I don't know if you wanted to add with a specific idea that it's just for quants.
No, that's a point, a very good point. Indeed, you can communicate with quants in acronyms. You can talk about the p-value of a regression, but then when you translate it to another audience, you have to be able to convey what does it mean that 2 variables or a few variables are multicollinear. Why did you drop one? Why one is significant, the other one is not. And indeed, it's very important to know how to tailor and to adapt your findings, even if they are intermediary findings, so that people don't lose you. Because then if they lose you, then it's very hard and it becomes frustrating, and at the end point you have troubles reuniting with the team. Another thing that I found helpful is, besides the communication, is the verbal aspect, but also the documentation. It's very important to document the intermediary phases of a project in plain English, and not only cut and paste a certain output from Excel and without interpretation, because later on in the project, when someone else in the team, maybe with a non-technical background, is asking, why did we end up in the end with this selection of variables, you can go back to your previous memos and see, look, in this week we discussed, we presented, this is the document that reflects our discussion from that week. So I think this is very important, and it proves to be very successful if it is followed. I mean, it will increase you will earn a lot of respect from the team. You will become a go-to person in the future. It will promote you. You will be given teams to manage and to mentor at your turn. So I think this is an important aspect.
So Maggie, do you have any kind of quant?
Yeah, let me sort of put it in the context. When people come to me, I get to interview most of the investment professionals that we hire. And when people come in and interview me, I kind of ask them a question, and I'm usually working on the computer, and say, you know, here's an example. Small cap or low volatility stocks outperform high volatility stocks. Now, if you think about traditional finance, risk and return should be related, right? Beta. But empirically, it's the opposite, that the riskier high vol stocks do more poorly than the low vol stocks. Why is that? And I just throw that out as a hypothetical to the people I'm interviewing. That was the last one. I usually give a quiz like that. And it depends, and I kind of gauge people's answer to questions like that as indicative as to how well they're going to perform with this kind of problem. A, you have to think on your feet. B, it kind of demonstrates to me how you develop an argument and how you present the argument. And the reason this kind of thing is important, to bring it back to my arguments earlier about having a theory and the importance of a theory, is what theory you weave around a question determines a lot. So let's take this low vol thing. There's an argument that you could make that low vol outperforms for some odd, just as a statistical artifact. And so I should invest in low vol stocks, and that's the end of the story. We don't know why it's happening, but it's happening and it seems to persist. So I should put together a portfolio of low vol stocks, and I'll beat the market. Another more sophisticated story might be, well, why is that happening? It could happen because investors prefer positively skewed return distributions. So think about what kind of return distribution do you want to have? Do you want to have stocks that have a high potential to underperform a lot? Or do you want to have stocks that have a high potential that are going to outperform by a lot? Normally, most people say, I want the outperformers, right? And consequently, what happens? Well, those stocks should become expensive. And if they're expensive, on average, a portfolio of them, some of them will go to the moon, but a portfolio of them should underperform. So if that's the world, then these these stocks with positively skewed distributions, which are also going to have high variance, right? Because variance is the second moment and skew is the third moment, are going to be expensive, they're going to underperform. But that leads to a very interesting set of questions about why is this happening? And the answer could well be that these expensive high vol stocks underperform. The cheap high vol stocks should therefore outperform. And by just avoiding high vol, you're missing half the story. You're underweighting the bad ones, but you're also underweighting the good ones. And so that theory leads to a more nuanced approach to putting together a stock portfolio. You want to avoid positively skewed stocks, and you'd like to have some of the negatively skewed stocks, which tend to be cheap. And so this is a sort of a quiz I would give people and just sort of judge their response to it. But it's how do you tell this story? How do you weave a narrative around this story? Now, if you're talking to your colleagues, you can certainly talk about skewness of return distributions and second and third moments of things. But if you're talking to a client or you're talking to your boss, who may or may not be technical, then you need to tell it in kind of a narrative form. And ideally, you'd be sitting there and you'd be drawing distributions about, here's outcomes, and this is a positively skewed distribution, and this is a normal one, and here's a negative skew. And you talk about the fact that some of these guys are high-flying stocks and are going to be really expensive, and chances are they're going to underperform if you put a portfolio of them together. But a simple graphic like that starts to get people's attention. You can look at it, and it provides an anchor for the discussion. So people that have come into my office and start drawing graphs on the board, well, they get an A+, and and move on. I'm sorry, I just rambled.
Oh, that's great. I mean, yeah. Do you want to kind of to add in terms of what do you think? How would you communicate to clients or?
Yeah. So one thing I wanted to talk about was how do we communicate whether the model is robust, is validated. How do we validate a model? Definitely there are the statistical metrics that you can use, the goodness of fit, that make you comfortable as a mathematician. But more than that, then it's the out of sampling. But more than that, if you communicate that the model is passing a Lehman scenario, if the model output is passing a scenario commensurate with the level of stress in the Great Depression, let's say, when the stocks lost 85% of their value, if you bring this element of history in the model, in the interpretation of the model, I sense that it brings a lot of confidence, and it is a very positive thing in communicating and convincing that a certain model is robust. So making it past the 1987 crisis, the dot-com crisis, I tested it against this scenario, and this is what the outcome is. I found this very important. And sometimes the managers themselves will ask you, okay, I understand this is the mathematical part of it, but I'd like to know, is this quantile that you're selecting from the distribution, is this quantile sufficient to get me through an event similar to the 1987?
So that's interesting point in terms of when you talk to managers who generally are older and more experienced than you, they have lived not just through the analysis of the past you're looking at the past 5 years, but actually lived through 20 or 30 years of 2 standard deviation or plus events, or just different tail events. So whenever the data is presented or the analysis is presented, they might take it always with a grain of salt, just because the models might not work. So sometimes including, in the quant language, some kind of regime switching models, something you adjust for different time parameters and different state variables. And, without talking about regimes, you can talk about different states of the world or looking at crisis, adjusting for crisis, testing in sample, out of sample, including the crisis period, excluding the crisis period, which types of crisis. Katie mentioned US dollar is different, but stock market or bond market crash and so on. So that's important. So Maggie, you mentioned about those. I'm still kind of having graphic image of those guys with suspenders and smoking cigars. So how do you go back? Not go back, but I guess. If we're sitting there and like, okay, we know all that and have heard all of that stuff, but not really understand, how do you describe your results to those type of people who actually think they have had lots of experience, and they did have, but they still, at that time, they as I remember, I went to a New York Stock Exchange, I was asking, they had this kind of storage compartment. So what is that for? I said, oh, we used to store cigars. So they still probably have had in mind that this, that's always will be like this. We always smoke cigars, and the woman's bathroom is where the telephone booth was there, right? Because there was only men's bathroom, and they had to refit it, to make a women's bathroom, and they had they didn't have space, so they kind of refit the telephone, which people don't use now, to refit it. So, but with that mentality, right? But we have lived for all of that, we know it, but at the same time, what you're saying, we might not trust. How would you do that?
That's an interesting question. It's sort of, let me describe to you one of our equity models, okay? If you're trying to evaluate a stock, let's take two examples. One is a public utility, really boring stock, right? It's not going to grow. All it does is pump out electricity. And if you're going to buy that stock, what are you buying? You're buying a stream of dividends, and that's about it. There's not many growth opportunities. So it's kind of like evaluating a bond, and it's a certain set of criteria that you use to evaluate that stock. Now look at Whole Foods. Whole Foods is a fast-growing company. It's got lots of opportunities. It can go in a lot of different directions. It's kind of at the leading edge of a customer kind of movement. And the criteria that you would use to evaluate that fast-growth company should be different, right? But when we first started doing what we did, all quants had a one-size-fits-all kind of model. They have to be cheap. They have to have good news. They have to have positive momentum, et cetera. And our shtick was, no, that's not right. A more sophisticated approach is to look at the public utilities and evaluate those kinds of stocks differently than you do the fast growth, high flying stocks. And that's the story we would tell prospects. And then we'd show them some proof statements of that. You could do a crosstab with the payoff to PE versus growth rate. And you find that PE matters a lot for these slow-growing stocks because it's basically how much are you paying for this bond, and it doesn't matter very much for the fast-growth stocks. Really, there it's all about growth opportunities. So we show them some proof statements. And for the typical client, that's the way I'd kind of approach it. But getting back to the sort of knowing your audience, in some cases we go into public plans, big state pension plans like CalPERS or something. I'd look up and see who the trustees are, who are the people that are going to be evaluating me, because I'll have 20 minutes to make my pitch, and it'll be in a formal proceeding. And in one case, one of them was a school teacher, and so I spent my time trying to teach. This is the theory, this is why we have this theory, here's the proof statement for the theory. In another case, I went in and it was a national laboratory, and everybody that was a trustee had a PhD in physics or math. And there, I put equations down and we'd show the theory, the actual mathematics behind the theory. And that's what they wanted to see. So how you develop and how you present some of these arguments depends on sort of the audience. And I'll give you a story about how I did it wrong. Talking about the cigar smoking crowd, I went into one finals and I started down this story about slow growing companies, and I wasn't thinking very carefully, and I just said, well, take a coal company. They're not fast growing. And it was a guy on one of the trustees for this pension plan, and he was a fundamental analyst. He's one of these old cigars, smoking suspenders guys. And he went absolutely nuts. And he said, what do you mean? Coal is the fastest growing industry in the country. We're doing all kinds of stuff with coal. We're exporting it. It's a growth industry. And so I'm sitting there going, oh, okay, I don't know. And all I care about is trying to sort of demonstrate this theory. Once I've got the theory down, it's a bunch of numbers that go into a computer. So I don't know where the coal companies end up. I thought they were slow growth. But I went back and looked, and indeed they were fast growth companies, and we treated them like Whole Foods. So we were doing it correctly, but my story about it was all wrong, and we didn't get that mandate. So there's kind of a lesson here. One is be able to judge your audience and do your homework. So if you're going into a job interview, you want to kind of look at who you're interviewing with and develop your stories accordingly. Two, you need to have this theory which you can sort of put into a 30-second elevator pitch. It should be very succinct. And the fourth thing is that you really want to have some diagrammatical kind of way of presenting it that's simple and kind of builds upon it. So.
Great. So Cristina, do you want to maybe share also some kind of no-nos that maybe you have done personally, or maybe just generally that should not be done?
Yeah. So along the lines of being a loner, the solitary quantitative analyst, I think this is a no-no. You have to engage a team, and you have to keep the team with you and lead the project. And I think it is very important perhaps to spend some time at the beginning of the project to explain some basic concept. What does it mean, a parametric model, a non-parametric model? Why am I not looking solely at a historical simulation? How am I conditioning? These kind of elements, of concepts are very easy to be explained if you spend the time. I wish I could have spent perhaps more time at the beginning in setting the rules. Likewise, the difference between stochastic and deterministic. When it's appropriate to use a stochastic model? When do I want to capture the idiosyncratic risk? When can I go with more of a scenario-based analysis, right? It's different when you analyze a portfolio of 100 corporate names versus a portfolio of thousands of consumer loans. The behavior is different. So I think it's a time well spent with your project team to keep everyone on board. So I would strongly recommend setting the key concepts in modeling.
So don't be a lone wolf.
Yeah.
So kind of maybe the last question, we can maybe wrap it up with more questions, is a more general, is about women mentoring and culture. It is a conference, it's the first conference, inaugural conference of women in financial mathematics, and it's a great idea. As Tanya mentioned, when she started, you could count them on the number of women on both hands. We have more, but it's still it's a way to go. So how can we have more women in quant fields? What do you think is the threshold of women needed in organizations in order actually to change the culture? And I know, Margaret, you have done some research, actually published work on that, and also maybe talked about women, especially your work on performance of women managers on risk-adjusted basis, and why they don't go into more riskier fields or riskier subfields of quant investing, and so how to maybe steer more women into risk-taking positions, and also mentoring. I mean, we have mentioned a lot about mentoring personally. At least I was definitely helped to be where I am with a mentor. And is it important to have a women mentor or men mentor? I'm not sure necessarily. Maybe we can discuss that and how to find mentors.
That's a lot of stuff.
Yeah, so it's kind of like women
Well,
mentoring and culture.
Let me tell you,
Yeah.
I like to tell stories, so here's the story. There was an investment conference actually in Boston, and Andy Lowe was moderating a session that I was talking on, and it was on behavioral finance, and they had a very eminent scholar who had done work on testosterone and risk-taking. And this guy was going in, and they were doing mouth swabs on traders to judge how much testosterone they had, and then they'd watch their trading behavior in an experimental sense. And so I was a discussant on this paper, and so I said, gee, that's like not very interesting. Why don't you just look at real differences in testosterone, look at women versus men? And I did some empirical work on it that I was surprised no one's done. But I actually published a paper, and it's in the Journal of Investment Management a couple of years ago, on women in the equity management field, and I looked at how many there are, because nobody really knew, and the answer is about 13% of key investment professionals are female, and as you start to go up the food chain to, say, the CIO role, that drops to about 8%. So the good thing for all of you is that there's a lot of opportunities out there. I mean, firms are aware of this, and they're trying to diversify. They understand that there are lots of things that women can bring to the table that men can't. And so it's an opportunity for everyone in this room. I looked at performance, and I tried to adjust it for the risk and the nature of the strategy, and not surprisingly, women were as good a performer as men. You couldn't distinguish it in any kind of statistical sense. So the fact that there aren't many women in the investment management field doesn't seem to have anything to do with their productivity. I looked at the departures from the firms. You might argue women are more prone to leaving to have a family, and there was no evidence of that as well. So it didn't appear to be driven by departures. And then I looked at risk-taking, and there was a tendency of women, or there is a tendency of women to end up in lower risk parts of the business. So there's a higher relative proportion of women in index and enhanced index fields. There are, when you start going to more aggressive strategies, hedge fund kinds of things, you find a lower number of women. Now that could be discrimination, but it also might suggest that women tend to be more risk averse, and there's lots of other literature about risk aversion and gender which seems to bear that out. So one of the things I think on training is not only learning technical skills, which everyone in this room has, but also learning risk-taking skills, which is not something that you really get taught in a university setting. It's something that you either need to self-teach, or there are hurdles that you need to overcome. And it's not taking gambles, it's taking educated risks, and everybody in here should understand probabilistic behavior. But it is being comfortable taking risks. I know, since have been a CIO for a large shop, one of the things I was always trying to overcome was the tendency to be too risk averse. I worry about my staff. I worry about what happens in a financial downturn. I don't like to lever my alpha too much because things can go wrong. And I'd probably be flying in my private jet if I wasn't so risk averse at this stage. So the message, I think, from the research I saw was that, or the data that I looked at, is one, there's a lot of opportunity for everyone in this room. Two, the hurdle is risk aversion, and what you need to do is to recognize that in yourself if you are indeed subject to it, and not all of us are, and think about ways to overcome that.
Yeah. Cristina, would you like to?
Yeah, so in credit risk, I can say I've seen a difference between women or men. I think in the end it is based on everyone's each of us's personality. So I think women can be as successful. We are very analytical. We have a solid background. We have communication skills. So
We have a good start.
yeah.
Great. So I know it's 12:25. We need to finish, and we have
Okay.
6 minutes.
Take a few questions.
yeah.
We can go a few minutes over if we need
Okay.
to.
Yeah. Question.
I'm probably loud enough. So,
Oh, where's it?
It's for the video. Yeah.
Okay.
I just want to know which is more challenging going into meetings, walking in as a woman to a group full of men or walking in as a quant to a group full of fundamentalists.
I don't know. Do you guys?
I think both are equal. Yeah, it depends how you go in the room and how prepared you are for that meeting. So if you tailor your message and your language and your to the audience, then you will be successful in both meetings. I'm a true believer.
I think the suspenders guys are kind of history at this stage. Thankfully, if you look at who's successful these days, they're all PhD types. Fortunately, I will say that I've walked into meetings as the boss and would sit in the back of the room, kind of like you are, and people would be giving a sales pitch to us, and I'd ask a few questions, and they didn't know their audience, and these were men. And they'd kind of poo-poo me and turn to my trader or something and try to answer the question. And those folks didn't get to do much business with us. So.
Right. And I think the second part is about more communication. So, and the first one is just, we're a bunch of men, so it's more self-awareness or maybe your experience, or even if you notice. I mean, for me, I got that early on when I was MIT undergraduate. I was living in a co-ed dorm, but there are not so many women in that co-ed dorm, so pretty much it's like living in a frat house. But so for me, I just don't care about. I don't think about it. It's not. It's like when I go into presentation, I don't really think are there any men or women, or even think of myself as a woman entering. So, but it's more experience, I guess, more. But the second one is communication. So, and I know that I need to. I mean, the first one is just maybe just dress appropriately, and so you don't. So you don't. You start having a discussion, and but the second one is just more about communication, and it's important to just know your audience and know that they know you as well. So I would say I mean, for me, it's maybe more challenging communication because it's a work in progress. Yeah, you have a question? Yeah, what is it? Here
Wait
the
for
second
the
one. Thanks.
recorder.
We've spoken a lot about how to get ideas across very clearly, but we haven't spoken much about how to have communication with difficult clients or difficult bosses. Sometimes you can do things as simple as you can and as clearly as you can, but it's very difficult to communicate with someone who has a preconceived notions. And I've faced that in my job where I know for sure X is the right thing to do, but when I'm talking with a client who thinks Y is the right thing to do, it's extremely hard to have that kind of a conversation with them. With all the graphs, message as simple as A, B, and C, it's still difficult. I mean, do you guys have any thoughts on that?
Yeah, that's hard. I mean, fundamentally, I would go into some of these finals presentations, and there'd be a group of people who are dead set against quant. They just think that the stock market is too complicated an animal. You need to be a fundamental. And when people start to have their minds made up like that, it's incredibly difficult to change them. So the only thing you can do, in my experience, is to put proof statement after proof statement in front of them. And they have to, if you bury them in enough support, I mean, there's a reason you think that you have the right answer and that they're wrong. And so what is that proof statement? And what other ways can you get at that proof statement and put it in front of them? It may be one table, it may be 5.
Yeah, I just want to add to a couple comments about that. You will have other experiences where you're asked to do analyses, and it's even worse that they're asking you what you know is the wrong question.
Yeah.
And I think in those cases, going to the point about the proof and the explanation, if you're unsuccessful in the communication, part of it is actually going away and trying to figure out why you're unsuccessful. And I'll just tell you one story. I teach usually one class a year, and I had one class where I was teaching a pretty high-tech derivatives course, and I taught it on 2 tracks, sort of derivatives for poets and then derivatives for the quants in the room. And I had someone who was really, really confused about a certain aspect of the modeling of derivatives, and they came in for office hours, and we spent, I was exhausted, maybe 4 hours. I tried to explain it every way that I possibly could, and they just weren't understanding it. And then my research assistant came into the office, and I said, look, here's what I'm trying to explain. And she said, oh, here's how I think about it. And the light bulb went off like that for my student, and they aced everything after that. And so I tell that story because sometimes we get really convinced that how we understand something is the way everybody else should understand it. But there's usually many different ways to think about these things. And so I think going to the comment about know how to do the proof and how to present it, that if someone's asking a question you know is wrong, or they're asking you to do something and you think it's the wrong family of analysis, the incentive to go back and figure out a new way to communicate it, or to reach out to other people who might have a different way of communicating it, is important, because at the end of the day, if you're unsuccessful and you go do it, the person is going to come to you and say, how come you didn't explain to me this was wrong? Like, the failure is going to end up being yours in many ways. So I think it's important to get to that right proof.
Right, question. Third row.
Hi. I think the topic of communication is really important. And when I think about communication, I think of it in 2 ways. One is the content and the structuring of that content, and the other is the actual delivery. And having grown up in the academics and the sciences, I've seen a lot of women have great content but fumble on the delivery, and then it's, lost in translation. So I wanted to know if you can comment, I think it'd be great for the room too, on, the delivery part of communication.
Yeah, so as I mentioned before, I found very helpful to take a step back and try to explain the key concepts, the language, you can talk about an extreme value distribution and the fact that you fit one to a data in layman's term. So doing a little bit of education, perhaps not necessarily geared to that specific content of the problem, but talking more about the context is very helpful. So there is an educational part in trying to deliver the output of a model and what it represents. And I think it's time worth spent.
And also, delivery, it depends. So we talked about the audience, right? Depends who you deliver, right? So we talk about clients, bosses, other quants, students, right? So try to find a common language or experience. And it could be experience not necessarily finance. You could start, especially if you don't maybe get along in terms of, fundamental versus quants, start talking about art. Totally different, or sports, right? And then, you'll find something in common. So if there is some kind of a common ground, you will find, or at least you will acknowledge the differences without coming with biases. Because the worst is just people come with biases, and then what's the point of a meeting? You don't learn at all about each other, right? Or about approaches. So try to, to have an open mind.
I think I was just going to say one other thing. Yeah. Don't hesitate to ask someone to take a preview of what you're trying to communicate. right? I mean, if it's a new concept, a new topic, if it's a really important meeting, if you're not sure you're pitching it at the right level, if you don't know if the graphic is as, if you think you have a graphic that just says everything, you should show that to somebody else and see if they think it shows them everything that you think it shows them. And especially early in your careers, I mean, people love to help other people starting out. And someday you'll sit in our shoes and you'll be helping people who are starting out. And don't forget either one of those. Don't forget to reach out to other people and let them help you, whether it's practicing your first presentation, whether it's looking at the slides you designed, whether it's reading the paper that you wrote. And that doesn't necessarily have to be someone right in your area. Just make sure you're careful, take the names out of it, take whatever's confidential out of it. People can still get the idea of what it is you're trying to do, but reach out for that help.
Yeah.
I agree. I want to just put a footnote on that. I agree completely with what she said. When I first started selling our stuff, where PhDs were really smart, we understand all this stuff, and I had slides, and the titles of some of those slides were, volatility matters a lot for stock type X or something. And I sat down with a person who specialized in marketing, and she says, these slides are all wrong. And I go, what do you mean? I'm smart. I know this stuff. And she goes, no, every title of every slide should be what it is that you're trying to, the conclusion. What's the conclusion someone should draw from this chart? And it's basically, you can make money by. And it was asking for help. I had never looked at it that way. I was always thinking about slides as title and footnote and data, but there is a lot to be gained by talking to people who are experts in this stuff. There's a real skill set there.
Mm-hmm. Yeah, and I would add that when you do a presentation, always check whether the message is understood and ask for questions, pause. And also what I found helpful, and I mentioned this before, is document in plain English, give ahead of time, 24 hours in advance, the document to be read by the audience. Usually when you go directly with the PowerPoints are not very helpful. More helpful is a memo in plain English with the graphs. But try and imagine you're writing a chapter in a book, where you need to start with an introduction. Give this ahead of time to the team to absorb it, and then you will see based on the questions that come up in the meeting whether more is needed or that's enough. I found that very helpful.
I can speak about yeah. So coming back to the communication and the delivery, I think that especially in academia, we need to put a lot of effort in writing better. Mm-hmm. And we don't do that. You get the students, I don't think we teach them how to write well. They get extremely frustrated when they prepare something and it is not up to the standards of scientific literature. And I would give a very strong advice to invest not only on how you talk and how you present, but also on how you write. Because after all, the papers you present are your legacy, the legacy you create for your scientific career. This is one point I wanted to make. The other point, coming back to what Maggie said about risk aversion, I see this a lot in the academic community. When young people start their research careers, they fear so much. Like they say, am I going to work on this problem, and am I going to be able to publish it easily? Or will I have problems sending my paper to a very good journal? And I have observed that female students are more risk averse than male students. Which is, and I think that this is strange because it's an oxymoron. After all, the university is the universe of an open mind, right? So you should not be afraid. But I would like to stress that this risk aversion starts very early in our scientific careers. And this destroys potential value in the future, so. Yeah, it's a very good point about the risk aversion.
Yeah, and one last point, I mean, an interesting test is for yourself to go back to a project that you did a year ago. And then if you don't understand where those numbers come from, it means it wasn't properly documented, and we can do
Love
a
that.
better job.
That's good.
Love that. Okay, one last question.
I was curious, there's a lot of things coming out now with data visualization. Is there any way that that can work into how we can communicate more difficult mathematical concepts to a broader audience, or is it just kind of confusing things more?
I mean, I use a lot of it in my work with my colleagues on systemic risk, specifically when I try to understand that systemic risk is not because of banks or insurance companies or sovereigns. It's the problem comes from the interactions, and how do you actually graph interactions? So I use network theory to do that, and you have to use not just names and nodes, but you have to use thickness, you have to use colors, you have to use directions, right? So you actually, and you have to, the distance tells you the story, right? So you have to use pretty much all different types of network theory. Even, you know, when we were having breakfast, I was looking at this interesting graph that IPAM Institute did in terms of different sub-institutes within IPAM, and they calculated some kind of, I forgot the name, not I get back to centrality, but another metric where they calculated number of participants who attend both, and then divided by the sum of number of unique participants attending 2 conferences, and then the thickness of the thickness of a connection was a function of that. So pretty much that's information, right? It's not just like if you just tabulated this as, you know, how many people attended this. It's not really I mean, it's interesting, but it's hard to read it. But actually just looking at that, the depiction, you know, it's really, you know, it's very interesting. And I liked what you guys actually put the mathematics behind it, the equation, how we did it. So I would say it's really, for us, it's important, especially when you try to cross over different fields and try to bring more information and more data. You need also maybe a third dimension, and how do you graph it. So I would say that's really important. We spend lots of time doing this, and we show tables and we show graphs for the same information, and people mostly comment on graphs because that's easy to read and it's easier to understand.
You know, one of the classic graphs ever produced was by this guy Charles Menard in 1869, and it was traced Napoleon's attempted invasion, right? I mean, many of you have seen that chart. And that's 6 dimensions on one chart, one 2-dimensional chart. And so you can do a lot of this stuff with fairly low-tech solutions. That being said, I've seen some amazing stuff that Andy Lowe has done where the dynamics of a process are really important, and in that case, having a visualization of things changing through time, you know, a graph that all of a sudden colors start to explode, that's more of a video than it is a graph, is also relevant. So it sort of depends on the problem you're trying to solve. My usual advice is keep it simple, but.
Well, that's why I was wondering, sometimes it becomes too difficult for your audience to, now they're just trying to figure out what they're looking at instead of hearing what you're trying to convey.
The question is, are you using the more complex technique because you think it's fancy and pretty, or because it actually tells the story better? And I agree. I think you stick with the simplest presentation that tells the story, but not one that masks the story. So, and there's a lot of judgment in that communication. And again, that's why other people's input and looking back, I love that idea, looking back at things you've done in the past to see, wow, can I even tell what that graph is? Well,
why did I make that decision?
You know, did I?
You are your own audience.
And did I even label the data sources, the assumptions, the, you know, the axes or the plot, whatever it is, right? And it's a good test. It's
yes, of your own writing skill.
Thank you to this panel.
Thank you, guys.